Forex hedging is a risk management strategy used in the foreign exchange or Forex market. It involves taking an offsetting position in a currency pair to protect against potential losses from adverse price movements. Imagine, for instance, a trader who believes the euro will appreciate against the US dollar. They buy euros, expecting to profit as the euro's value rises. However, the Forex market is volatile. Unexpected events can cause currencies to move against a trader's predictions. To mitigate this risk, the trader can simultaneously enter a hedging position by selling a similar amount of euros. This way, any losses from one trade are offset by gains in the other.
Businesses and traders operating in the global marketplace often deal with multiple currencies. This exposure to various currencies introduces a level of financial risk that can be challenging to manage. Fluctuations in exchange rates can significantly impact their profits and losses. Even small changes in currency values can lead to substantial financial consequences. Forex hedging allows them to mitigate the risks associated with these fluctuations. By employing various hedging techniques, traders and businesses can create a buffer against adverse currency movements. By using hedging strategies, they can protect their investments, manage cash flows, and ensure greater financial stability. This proactive approach helps in maintaining predictable financial outcomes. For example, a US company importing goods from Europe knows they will need to pay in euros in the future. This future payment obligation exposes them to the risk of currency appreciation. If the euro appreciates against the dollar, the cost of their imports will increase. This could lead to higher expenses and reduced profit margins. By hedging their currency exposure, the company can lock in a favorable exchange rate. This ensures that they know exactly how much they will pay, regardless of future market movements. This protects them from potential losses due to currency fluctuations. Ultimately, hedging provides peace of mind and financial predictability, allowing businesses to focus on their core operations without worrying about exchange rate volatility.
A multinational corporation with subsidiaries in different countries regularly faces currency risk when repatriating profits or managing intercompany transactions. Imagine a UK company with a subsidiary in Japan. The Japanese subsidiary generates profits in yen, but the parent company reports its financials in British pounds. If the yen weakens against the pound, the parent company will receive fewer pounds when converting the subsidiary's profits. To hedge against this risk, the company can use forward contracts or options to lock in a specific exchange rate for converting yen to pounds. This ensures that the parent company receives a predictable amount of pounds, regardless of short-term currency fluctuations.
Forward contracts. Locking in future exchange rates. Forward contracts are agreements to buy or sell a specific amount of currency at a predetermined exchange rate on a future date. They are particularly useful for businesses needing to make or receive payments in a foreign currency at a later time. Let's say a US importer has to pay 1 million euros to a German supplier in 3 months. They can enter into a forward contract with a bank to buy euros at a fixed rate. This protects the importer from potential euro appreciation over the next 3 months. Even if the euro strengthens, they will still get the agreed-upon rate.
Currency options, flexibility, and risk management. In this section, we delve into the intricacies of currency options and how they can be a powerful tool for managing financial risk. Currency options provide the right, but not the obligation, to buy or sell a currency at a specified price on or before a certain date. This unique feature makes them highly versatile in various trading scenarios. They offer more flexibility than forward contracts, as traders can choose not to exercise the option if the market moves in their favor. This flexibility can be particularly advantageous in volatile markets, where predicting movements can be challenging. For instance, a US exporter expecting to receive 500,000 euros in 6 months can buy put options on EUR/USD. This strategy allows the exporter to hedge against unfavorable currency fluctuations. These options give them the right to sell euros at a predetermined rate, protecting them from potential euro depreciation. This means that even if the euro's value drops significantly, the exporter is safeguarded against losses. If the euro strengthens against the dollar, the exporter can let the options expire and benefit from the favorable exchange rate in the spot market. This dual advantage of protection and potential profit makes currency options a valuable tool in risk management strategies.
Hedging with futures contracts, standardized protection. Futures contracts are similar to forward contracts, but are standardized and traded on exchanges. They allow traders to hedge against currency risk in a centralized and regulated environment. For example, a portfolio manager with significant exposure to European equities might use euro currency futures to hedge against euro depreciation. By selling euro futures, they can offset potential losses in their equity portfolio if the euro weakened.
Hedging in action. A practical example. Let's say a US-based company is expecting to receive £1 million from a UK client in 3 months. This scenario is quite common in international business transactions where companies deal with multiple currencies. The current exchange rate is £1 equals $1.25. This means that if the company were to exchange the pounds today, they would receive $1,250,000. The company is concerned that the pound might weaken against the dollar, reducing the value of their receivables. A weaker pound would mean fewer dollars when the pounds are converted. To hedge this risk, they decide to use a forward contract. A forward contract allows them to lock in an exchange rate today for a transaction that will occur in the future. They contact a bank and enter into a forward contract to sell £1 million in 3 months at a predetermined exchange rate of £1 equals $1.24. This means that regardless of the market fluctuations, they are guaranteed this rate. 3 months later, the pound has indeed weakened, and the spot exchange rate is £1 equals $1.22. This decline would have resulted in a significant loss if not hedged. However, due to the forward contract, the company can still sell their pounds at the agreed-upon rate of $1.24, receiving $1,240,000. This ensures that their financial planning remains intact. This effectively protects them from the adverse currency movement. By using hedging strategies like forward contracts, companies can mitigate risks and ensure more predictable financial outcomes.
Choosing the right strategy. Factors to consider. When choosing a Forex hedging strategy, several factors come into play. These include the trader's risk tolerance, the time horizon of the trade, and the market outlook. Traders with a low-risk appetite might prefer options, offering flexibility and limiting potential losses. Those with a longer time horizon may opt for forward or futures contracts. Market outlook also plays a role. If a trader expects high volatility, options might be more suitable as they provide protection against significant price swings.
Benefits of Forex hedging: stability and risk mitigation. Forex hedging offers several benefits for businesses and traders. Risk mitigation. It reduces the impact of unfavorable exchange rate movements on profits, investments, and cash flows. Financial planning. Hedging allows businesses to forecast future expenses and revenues more accurately, facilitating better budgeting and financial planning. Competitive advantage. By mitigating currency risk, businesses can offer more competitive pricing to international clients and gain an edge in global markets. Navigating currency fluctuations with confidence. The Forex market is inherently volatile, and currency fluctuations can significantly impact international businesses and traders. Understanding and implementing effective Forex hedging strategies is crucial for managing risk and ensuring financial stability in the face of these fluctuations.
CY Securities provides the tools and resources necessary to help traders implement these strategies and trade with confidence and precision. At CY Securities, we empower traders by providing education tailored to you. Catering to traders of all levels, we offer a diverse range of educational resources. We ensure you are not trading in the dark. Our expert insights and analysis support your trading decisions, helping you navigate the markets more confidently. Ready to dive in? Open your account with us today and begin a journey of growth and learning. Embrace the opportunity to grow, learn, and excel in the dynamic trading landscape with CY Securities.